Right now, a $3 trillion shadow banking system is quietly locking away a massive chunk of your 401k and pension money. Millions of hardworking people hand over their retirement savings to institutional asset managers, operating under the assumption that those funds are kept in safe, easily accessible accounts. But as economic anxiety rises, investors are getting nervous. They are asking to pull their cash out, and for the first time, they are being told no. Major financial institutions like Blue Owl has completely stopped redemptions on certain retail funds, while BlackRock has started to limit withdrawals. The panic reached a point where Blackstone, managing an $82 billion credit fund, actually had to use its own money, and even the personal money of its employees, just to pay people out. These denied withdrawal requests are the initial warning signs of a highly leveraged system straining under pressure, leaving the public's retirement money trapped on the inside. To understand how those funds got trapped, we have to look at how businesses normally borrow money. Traditional banks operate under heavy government regulation, with strict legal limits on exactly how much risk they are allowed to take. Over the last 20 years, an era of historically low interest rates meant those safe, regulated loans barely generated any yield. To find higher returns, massive financial institutions had to step outside the heavily monitored banking sector. They built what economists call the private credit market. This is a shadow banking system that allows asset managers to lend cash directly to borrowers, completely bypassing traditional banking rules. Instead of buying publicly traded bonds, this unregulated money is used to issue massive private loans directly to privately owned companies, privately owned real estate developments, and private infrastructure projects. And the capital funding these shadow loans didn't come out of thin air. That $3 trillion came directly from everyday pension funds, insurance companies, and everyday retirement accounts. Asset managers sidestepped the exact regulations designed to prevent bank runs, and they used the public's own retirement money to do it. The danger here lies in a massive mechanical flaw at the center of private credit, a severe mismatch in timing. If you log into your checking account, you can transfer your cash in seconds, but an asset manager cannot easily sell off a physical skyscraper or a multi-million-dollar corporate loan. These specific types of private loans are legally bound in long-term, highly illiquid contracts. So when economic panic sets in, thousands of retail investors simultaneously demand their money back, expecting overnight transfers. The funds simply do not have the cash on hand to pay them, and they can't liquidate billions in infrastructure in 24 hours to get it. This illiquidity is the exact mathematical reason why these shadow banks are eventually forced to freeze accounts and lock retail investors in. This diagram of a leverage stack shows why a frozen private credit market threatens the rest of the country. In our modern economy, nearly every single financial layer operates using borrowed money, secured by the debt of the layer directly beneath it. At the foundation, the everyday homeowner or local business carries a mortgage or a loan. Right above them, the bank that issued that specific debt is heavily leveraged as well. Moving up, the private credit funds holding massive packages of those underlying loans borrow money to maximize their returns, and the pension funds pumping cash into those credit markets are leveraged too. Sitting at the very top of this precarious structure is the United States government, operating as the most heavily leveraged entity of all, with $38 trillion in national debt. When that private credit pool at the bottom dries up, businesses suddenly lose the ability to refinance their maturing loans. To survive, they are forced to aggressively slash costs and lay off their employees. As people lose their paychecks, consumer spending rapidly drops off. That directly leads to falling corporate profits and a steep decline in government tax revenues, putting severe stress on the entire economic structure. Because every layer is borrowing against the one below it, a single fracture at the illiquid bottom layer automatically transmits that financial devastation upward, destabilizing the whole tower. We have seen exactly how this architectural flaw plays out before. The extreme leverage in today's private credit market mirrors the severe fragility we saw in the housing sector back in 2008. This visualization shows the reality of that collapse. During the crisis, it felt like the entire country was failing to pay for their homes. But mathematically, less than 5% of mortgage loans actually went into default. Because the global financial system was so wildly over-leveraged, that tiny 5% fraction was enough to nearly trigger a total economic collapse. And the people at the top of the banking hierarchy are actively sounding the alarm. Speaking on the current stress inside the private credit markets, JP Morgan CEO Jamie Dimon recently issued a blunt warning. When you see one cockroach, there are probably more. The most important protective measure you can take is to thoroughly audit your own investments. Know exactly what you own, check your exposure to illiquid private funds, and eliminate unnecessary personal debt. Trusting unregulated shadow banks with your retirement ensures that when the inevitable deleveraging event finally triggers, everyday retail investors will be the ones left holding the bag.